Yo, Gem fan, what is going on? Welcome back to another video. Welcome back to the channel, Dropping Gems FX, where my main goal is to lace you guys up with advice and tips on how to take your Forex journey to the next level and to take you guys along my Forex journey. Now, in today's video, I'm going to be going over two topics. They may be trivial to Forex traders who have been trading for a while, but if you're a beginner, if you've been trading for a couple of weeks, couple of months, you still might find this topic a little bit confusing. So I'm going to go over it. I'm going to break it down as simple as I can, and I'm going to help you guys out. If you find this video at all informative, at all educational, please drop a like, subscribe, turn on that bell notification, share this video with your friend who's trying to learn Forex or whatever. And without further ado, let's hop right into the charts. Alright guys, so getting right into the video, I'm going to use TradingView to illustrate and explain to you guys exactly what a pair is and what a pip is. So hopping right into it, in the last video, when we we're trying to understand what Forex in general is, we understood that the foreign exchange market is a financial market that allows us as traders to basically trade two currencies against each other. And the pair is just a terminology for the grouping of two currencies, right? So when we're looking at a pair, the two questions we want to ask ourselves, let me move this out the way, is essentially how strong is the first currency in comparison to the second currency, as well as what is the exchange rate between the two currencies, right? So if we look at the first question, how strong is the first currency in comparison to the second currency? What does that mean? So the first currency, if you look to the top left of the screen, right here we have GBP USD. The first currency in that pair is the Great Britain pound, and the currency following is a US dollar. In the pair, you have two currencies. The first acronym is going to be the first currency. The second acronym is going to be the second currency. So in this pair, if I'm looking for a buy, which just to illustrate would be this bullish channel, if I'm looking for a buy, buy, bullish, long, all means the same thing. It generally means that the price is going up. If I'm looking for a buy, what I am saying is that the Great Britain pound is going to be stronger than the US dollar. And so if we look back on the charts, right, we look down here at this low on June 30th, 2020 to the present, price has been climbing. The Great Britain pound has been gaining strength over the US dollar. That's simple, right? If we go a little bit further in the past, right, we're going to go to June 10th, 2020 at this peak right here. We have this downtrend for a little bit up until June 30th, right? So what that essentially means is that the US dollar for that 20-day span, I believe, right? Yeah, 10th to 30th. For that 20-day span, the US dollar gained strength over the Great Britain pound. Thus, price created this kind of short selling, bearish trend, right? All mean the same thing. These are just terminologies that traders use for basically price going up or down. All right. So, how strong is the first currency in comparison to the second currency? That is what we're looking at when we're looking at a pair, as well as another way to look at pairs is basically the exchange rate between the two currencies. Okay, so let's take current price at the present into consideration. Current price is right now at 1.307770, right? So that essentially means that for every pound that I have and that I exchange for US dollars, I will get $1.30, right? $1.30. Very simple, right? So if we go on to another pair, let's say Euro USD. Price is right now at 1.177. Essentially, I'm saying for every euro that I exchange for a dollar, I will get $1.17.
Stop it. Get some help.
1.17. Same thing. $1.17, same thing, right? So that is a pair. That is what you are thinking of. And it is very, very, very crucial to deeply understand what pairs you are trading, because different pairs move at different times of the day. For example, I trade GBP USD very, very often, almost every week. And I understand that maybe from, 1 o'clock to 10 p.m. US, price may not really move. It may range. It may set up for impulsive move when London session opens. And London session opens at 3 a.m. here, right? So that's when the banks open in London, obviously at 8 a.m. over there. So, for example, we have these two kind of impulsive moves, and then we have some ranges over here. Let me highlight that in a different color, so it's easy to see. All right, so it's ranging here. Then we have this impulsive buy right after, and then we have another range. Impulse, range, and another range here. Just impulse, make it a little bit easier to follow from here, the peak, and a little bit of range, right? So you have ranging, you have impulse, you have a short range here, short impulse range, and it's final impulse range. So those happen when obviously the Great Britain pound kind of rate. Okay, so if we look at the chart, right, we see we have impulse, and I highlight. All right, so if we look at the chart right here, we have this impulsive move, right, for a couple of hours. We have some ranging throughout the day. We have another impulsive move, some ranging, some small ranging, and then a small impulsive ranging and impulsive move, right? So it happens right after the other. This means that when the banks open in London at 8 a.m. London time, 3 a.m. here, right, we usually have an impulsive move. 9 times out of 10 we'll have an impulsive move. And then throughout the day, I'd say typically around 2 o'clock to around 10 or 12, price will be ranging, right? You can see that. So the way I would look at this is I would look to get into the market in this specific pair. I would look to get into the market somewhere around 12 to 240, take advantage of that impulsive move, and then get out the market as soon as I wake up. Let it range throughout the day. Go ahead and get back in if I'm not swinging it. If I'm just taking short movements at a time, I'll do that. If I'm swinging it, I'll just let it roll throughout the week, right? So it's different strategies that I use when I'm trading different pairs. But the general concept is to be aware of what pair I'm trading and what time of day that pair likes to move, okay? So let's go ahead and understand what a pip is, right? So a pip is just the term that represents the movement in price, okay? So I have 2 pairs here with 6 different prices, and the movements between them is what we're going to try to understand here, right? So we have GBP USD, and right next to that we have price at 1.29 flat, and let's say that the market moves to 1.2901. That movement from 29 flat to 2901 is a 1 pip movement, okay? Again, we're going to go over 1.29 flat to 1.2910 is a movement of 10 pips. Very simple, very easy. The next line we see here is going to be 1.29 flat to 1.3 flat. That is a movement of 100 pips, okay? So the general idea is to pay attention to the 4th number, okay? So on TradingView and on some other brokers or trading platforms, you might see a 5th number, right? This small number. Disregard that. It really means nothing. It's a very micro kind of a movement. It's insignificant. What you need to pay attention to is the 4th number. And for some pairs, the movement of 1 pip is going to be different because on some pairs there are not 4 numbers, right? So, for example, we have GBP JPY, right, where there's only 3 numbers, okay, right? And so you want to focus on the 2nd number is the movement of 1 pip, okay? So let's go back to GBP USD and come back here, right? So for GBP USD, this specific pair, The fourth number in the lineup is going to be 1 pip. The second is going to represent 10 pips of movement, and the third number is going to represent 100 pips. Obviously, the second number would represent 1,000 pip movement, but that is not typical in a day or an hour. Usually, that type of movement takes a while, right? So that is what we look at when we're talking about pips. And obviously we have a second example here, pretty similar to the first. We have Euro GBP, right? Prices at 0.89 flat. The movement from 0.89 flat to 0.8905 is going to be 5 pips. And then we can go ahead and try to figure out the next line, right? 0.89 flat to 0.8915, 15 pips. Pretty easy, pretty simple. Again, 0.89 flat to 0.9 flat, 100 pip movement, right? So these two topics confuse a lot of new traders, but I hope this video helps those beginners kind of, solidify the concepts in their heads. And, if you are not a new trader and maybe you just had a little confusion, still, I hope this video helped you in some way, some shape, some form. And it's very, very crucial to understand the pairs. As I said, you need to understand what time of day they move, as well as pips, because pips kind of carry into every other topic that we're going to cover in the training series, right? When we talk about risk to reward ratio, which will be the next video, right? That next video is probably the most important video you want to watch. And I'm not saying that because I want the views. I really don't necessarily care about the views at this point in time because my channel is very small. But pips in relation to risk to reward ratio will make you, or not, a consistent trader. If you follow risk to reward ratio, risk management, you will be a consistent trader. And really, that's the end of that, right? You need to understand how to count your pips, to understand how much money you might have coming in, to understand how much money you're willing to risk. It just plays into every aspect of trading, right? So that is all for this video. It's very short, very simple, very to the point, and I hope you guys were able to understand. And if for some reason, I may have gone too fast for you, please rewind the video. Make sure you have this down packed. And I'll see you in the next video where we're going to be talking about risk to reward ratio. Very, very important. Very, very important. So tune in. Okay, so guys, in the last video, I showed you guys how I took $100 and flipped it to over 1K in about 4 trading days, right? And usually what I have been doing for about a year and some change now, is I would deposit $100 on the Sunday on market open, and I would trade that throughout the week. Whether or not I made profit or I blew that account, I would do that consistently for the past year and a half, and I would take my profits out or just deposit another 100 if I blew that account. Just consistently practice my strategy, my trading plan, and hone in on my discipline. But I did not do that this week. I did not take my profits out. What I'm going to do is challenge myself, and I want to take you guys along this journey. I want to challenge myself to take that 1K account up to 10K. And I don't want to give myself a specific time frame, because then I feel like that kind of conflicts with my trading plan and my trading strategy, and I want to stay level-headed. I want to stay focused. So I'm just going to take you guys along the journey and update you guys along the way. And we're going to take that 10K and flip it to 50, and that 50 to 100, right? So stay tuned, subscribe, turn on that bell notification, and you feel me? Let's run it up. I'll catch you next time, Gen Fam.